Hey everybody, this is the overview of the Emini 5-minute chart for Tuesday, September 24th, 2024. And if we look at the daily chart first, there's a reason I usually have this on the Globex chart, and this is what it would look like. And there's less gaps, we can see more bodies, we see the overnight session. But the reason I want to look at the day-only session is because it illustrates a point up here, and that is we're getting, over the past 3 days coming into the day, 3 consecutive trading range bars. And this looks like barbed wire. Lots of overlap and just getting doji after doji. The market's at the top of a big trading range. We've had 2 legs up. You could say it subdivided into 2 legs, 1, pause, 2. Now the market is deciding. We're going sideways. The market's in balance. And when the market's in a tight trading range like this, it's in breakout mode. So the market's deciding, do we have to go higher or are we going to pull back? I think more likely the market is going to spend more time sideways, and I think the upside is limited. But we have the big round number, 5,800, not far above, so we may have to touch the big round number before we find selling. For the 5-minute chart coming into the day, we have consecutive bear bars, one being big, one closing on its low. It might be always in short, but we had this bull channel at the end of yesterday. The bars are above the moving average. It's not clear, but we do know, here's yesterday's high, that on the gap up, we opened just below yesterday's high. We traded above the high and found sellers above. I want to make one more point about yesterday. Yesterday was a tight trading range day with lots of overlap, and the range of the day was relatively small. It was about 25 points. And that's a small day if you look at the daily chart. And it doesn't matter what chart you're looking at, but the point I'm making is that whenever you have a small day, it increases the chances of getting an outside bar. So when I say we have a small day, I really mean when we have a small bar, because it applies to really any chart. Whenever you see an outside bar, typically the bar before it is relatively small. And of course, that's a generality. It's not always the case. But in general, when you have a small trading range day, and the odds are there are sellers above and buyers below, you can see the market doesn't have to go all that far to go below the low of the prior day. And we've already gone above the high of the prior day. What are the odds that bar 1 remains the high of the day, and this is a bear trend from the open day? It's probably about 20%. In general, only about 20% of days have bar 1 remaining as the high or the low of the day. But so far, so good for the bears. Bar 3, probably a minor reversal, only a doji, and we have a 3-bar micro channel. The first reversal attempt will probably fail, and we went outside down on 4, continuing lower, 5 and 6. Now we have a tight bear channel. It's in 2 legs because we have a pullback above bar 3, so 1, pullback, 2. But the channel down is so tight that we know it's a breakout on a higher time frame chart. If we think about the 15-minute chart, where every third bar is the close of 1 bar on the 15-minute, then bar 4 going above the high of bar 3 would not be a pullback on the 15-minute chart. This would simply be consecutive bear bars with a little bit of overlap, but no pullback. So at this point, tight bear channel, overall trading range. We might be in the middle of the range at this point with momentum to the downside. We may have to test lower. And then 7, a surprise bar. Bar 7, there's often a report at 10 a.m. Eastern time, so the close of bar 6 into the open of bar 7. So we got some range expansion on bar 7. But bar 7 is a problem for the bears. It's climactic and it's vacuuming right down to the bottom of a trading range. If we look to the left and we see higher lows in a bull channel. The most recent major higher low, maybe it was bar 75, maybe it was bar 69. But the point is the market broke below major higher lows. And technically, if we're within a trading range, these are really minor. But the fact that the market broke out to a new high here makes these more major. But the market broke far below these swing points. So the odds are these prices become resistance. So they were support. We broke below them. Any retest, we expect sellers. I said bar 7 is a problem for the bears. Yes, we expect a second leg down for the bears, but when it's climactic and the bar is at least 2 times, if not 3 or more times bigger than the average bar range, it's going to attract profit taking from the bears. Think about a bear who sold all the way up here. Maybe you sold the close of bar 2 and you get a windfall of profits, and you're testing below the low of yesterday where there's probably buyers. So 7, there's reason to expect buyers on the close of the bar, but there should still be a second leg down. But because of the nature of the pattern, we may get a deep pullback first. And then 8, we had an inside bar, but it's a decent bull bar, and 9 rallied even further. You can see we came close to the low of bar 69. So a breakout pullback, low 1, sell set up, but the rally from the low of 7 to the high of 9 was big enough for a second leg, probably buyers below. Low 1s typically fail and then pull back, and then we get a low 2, and then trend resumption. But to call this a trend, I think, is a mistake. This looks like a bear leg in a trading range, and while I think we're going below the low of bar 7, I think the downside is limited. And if we think about the market cycle, we have a spike on bar 7, a pullback technically on bar 9, implied pullback on 8, but went above the high of a prior bar on 9. And now we're in the channel phase, and you can see the market is going sideways to down. It's channeling down. So the spike is the strongest part of the trend, and then we pull back, and then we get a weaker second part of the trend. Leg 1, pull back, maybe leg 2, maybe pull back, and then maybe leg 3 down. 1, 2, 3. So bar 14, breaking out to a new low. But if we think about the market cycle, channels evolve into trading ranges, and we have a stop order buy above bar 8 that trapped traders. The odds are we'll come back and test this price. And if you think about it, some unfortunate bear sold the low tick of bar 7 on its way down, and then they got this and this. And what are those bears going to do if we get back to their original entry price? They're going to be so disappointed that they may look to just exit the position at their original entry price at break even. So 14, a little bit of a sell climax. It's a trend bar, and it's the strongest trend bar in the entire channel down. And that might be a little climactic. Plus it's 3 legs down, or you can call it 2 legs, 1, pull back, 2. But again, because of the market cycle, I suspect we will go back up and test somewhere up here. You can call it the high of bar 9 before we fall for a measured move down. 15, an outside trend bar, good for the bulls. It's an always in flip. I think bulls can buy above 15, and bears, if they're short anywhere for any reason, they probably exit above 15. Follow through 16, more follow through 17. We have a bull breakout, another bull breakout, another bull breakout. So we're getting breakouts with follow through. We have 3 consecutive bull trend bars, uniform in size. Yes, there are tails above the bars, and that is a problem because we know that's a parabolic wedge on a smaller time frame. But the breakout is too strong, and we have open gaps. We have little overlap, even though there are tails. As soon as the bar closes, traders hit buy the market. The bar sells off into the close, but then traders buy the market. There's no tail below these bars. So there is a sense of urgency. Traders trying to enter on a pullback are being forced to chase the market. They're trapped out. So it might be by the close 16, by the close 17, always in long, probably going higher. Remember I said there's a 20% chance that bar 1 is the high of the day. And at this point, maybe it's 40 or 50%, maybe even higher. But then when you get this, we go right back to maybe 40 or 30% chance that bar 1 remains the high of the day. The bull's at a minimum looking for some sort of measured move based on the breakout, maybe using the bodies that takes us just above the bar 1 high. And then more follow through on 18. And you can see we remained technically in a breakout, a spike phase, all the way until here. We finally got a pullback below bar 25 on bar 26. Is 25 a good stop order sell? Of course not. It's maybe a 10 or 12 bar micro channel. The signal bar is a bull bar. There's a lot of momentum. We have trapped traders, not a lot of overlap. And this could all just be one leg. And the odds are the first pullback will be minor. The first reversal attempt will be minor. It'll be a pullback. And we'll get a second leg up. And then we had buyers below 25 on 26. High one buy. It's not ideal, and it can be difficult to hold long here when you start getting more overlap and you're getting high in the range. Plus, I mentioned the market cycle down here, and the same thing applies here. Bull spike, implied pullback. So we had a bull spike, consecutive inside bars, I pattern, another breakout, another I pattern, another bull breakout. So 3 pushes up, and a lot more overlap here than here. So the market's channeling, and we may have to test the bottom of the channel before we go much higher. So there's a risk that we fall down here. But instead we got bar 29, and 29, we know it's either a measuring gap or an exhaustion gap, and traders are deciding what it is, and we need more information. At a minimum, well, I will say one thing about exhaustion gaps. Exhaustion does not necessarily mean reversal. It just means you're probably going to pull back and at least go sideways. And that's true for any big bar. Just like bar 7, we went sideways for a lot of bars. But you typically go sideways after big bars for 1 to 3 bars. I wanted to mention one more thing. Let me back up to here. Bar 14. And I thought this was interesting. If you look at Friday, we had a similar pattern. Climactic bear breakout. This one happened to get follow through. And then 57, disappointing bar, probably buyers below 57. And at this point, we have to start thinking about, you should always be thinking about the market cycle. But if you think about it, we have a bear spike, implied pullback. Now we're in the channel phase. The market is channeling down to a new low. But the odds are there were buyers below 57, and we'll come back and test the high of 57 or even 56 before long. And because of the market cycle, because channels evolve into trading ranges, and they typically do not break out in the direction of the channel, I thought it was more likely we would have buyers below and come back and at least test here. And then we ended up getting a fairly strong reversal. And it's sort of the same thing that happened today. At least the same idea. Climactic breakout, we pull back, we start the channel phase, and there's buyers below, and we get a strong reversal up. So, measuring gap or exhaustion gap. At a minimum, 29 should get some sort of second leg. We have trapped traders below. Some traders sold the high of bar 1. They got trapped on bar 29. That's a disappointing entry bar. And they may use any pullback to exit their shorts. Maybe a bear sells here, scales in higher. They get bar 30, and they look to exit their shorts at their original entry price. And they'll exit break even on that trade and with a profit on the scale-in trade. And that's what leads to second legs. But bar 30 itself is strong enough for a second leg down. So now we have a pause, we have consecutive inside bars, which is a breakout mode pattern. And the bears are hoping it's big down, big up, or at the top of a trading range, and this leads to a reversal back down. The bulls are hoping it's a bull trend, and this is a trend resumption setup. Second leg down for the bears, 30, pullback 32, and then we had buyers again around this area. Now we have a high 2, 33. Always in bulls, if they got out for any reason, they can buy again above 33. But I mentioned over here, it was hard to be long, and it's same problem here. It can be difficult to hold long when the market is big down, big up, overall trading range. Also, look at the breakout from 15 to 29. How much of the breakout, how much of this bull leg is actually breaking out of the bars to the left above bar 1? Probably 85% of this entire breakout is overlapping here, and only 15% of it is actually breaking out. And we got no follow through on 30. We're going sideways. So as far as the bull argument goes, we'll still probably get a second leg up, but I suspect it will be limited because of the nature of what we've had over the past few days, which is lots of trading ranges. And the odds that we get a bull trend after this kind of sell-off on the open is unlikely. Maybe always in bulls get long here. 36, maybe it's a wedge. 1, 2, 3, 30, 33, 36. Reversal bar, you can buy above it, or you buy above 37. Filled on 38, it's a good entry bar, more follow through 39. But you had buy the closed bulls on 29, disappointed with all of this sideways to down, and they may look to exit at break even. Moving a little bit higher, but you can see maybe a bull bought here, maybe a bull bought above 37, always in long, okay to buy above that bar. And we hit 1 times the initial risk. So say you buy above this bar, stop below. We go 1 times the range of the bar, traders take profits. Now you have bar 40. And even though we have a 5-bar micro channel, 2 of the bars are bear bars. So look at all the overlap. This looks like a trading range. So we had a buy climax. Now the market is in a trading range. You can call this a big low 2. It's a double top. So low 1 over here, low 2, 40. Even though this will probably get a second leg, if the market is in a trading range, we can have a deep pullback first and then a delayed second leg for the bulls. So I think it's reasonable to exit longs below 40 or 41, bear bar closing on its low. And then decent looking bear breakout, but bad context. We're still within this trading range. We've had a lot of bars above the moving average. The bull trend was pretty decent. There was not much selling pressure through here, and that will limit the downside. Disappointing bar 43, so not a good buy signal, but also not what the bears want to see when they're trying to break out of the trading range. We're starting to get buyers below 37. Maybe we'll fall below 36 and find buyers, and the bulls will get a second leg. And then a second leg up for the bulls. But bulls who bought the close of 39, disappointed, they're trapped, they're getting a chance to exit at break even, and they'll take it. 40 through 43 is a strong enough bear breakout that this should get a second leg down. But same idea as this breakout. Second legs in trading ranges are delayed and you get deep pullbacks. So yes, they should get a second leg, but that does not mean you sell in the bottom of the range. It means you look to sell in the upper third of the range and look for a second leg down. Price vacuums up. Maybe it's a leg 1, pullback. Leg 2, we pause. Second leg trap, maybe on a smaller time frame, and nested 1, pullback 2, 1, pullback 2. 45, a big bar, and then 46, a small bar that's disappointment and or resistance. And then we get sellers on 47, probably going to test lower and test the 43 low. The bulls get a brief second leg, but resistance above, and we start to drift sideways to down. Lots of overlap through here. But then we got bar 57. I'm just going to delete yesterday's high. 57, this bar stands out as opposed to all the other bars, especially through here. What do you notice about bar 57? You'll notice the overlap, or the lack of overlap. So all of these bars have significant overlap with the prior bar. But 57 broke out below the low of 56, and there isn't much overlap between that and the distance we went down. And that's a decent bear breakout. It does not mean that the market is going to convert into a strong bear trend. However, I do think the bear breakout 57 needs a second leg. But because the market's in a trading range with lots of overlap, the second leg can be delayed, and rather than sell down here, traders are going to look to sell a pullback. Maybe they'll sell the low of 56. If you think about it, 56 was not a very good stop order sell. So traders can buy below, betting that if it's a bad stop order, it's a good limit order. So bulls buy below. Maybe it's a low 1 or low 2, bottom of a trading range, consecutive bull bars. You buy below and you get trapped on 57. This red line is your entry price. And if the market comes back to test that line and you're a bull and you just bought and sat through this drawdown, you're probably disappointed and you'll probably look to exit at break even. 58, we tested that break even price and we're finding sellers above bars and we may drift down, and here's potentially the second leg down, bar 60. So 57, pull back, and then 60 went one tick below 57. In this case, we went lower on 61. But 61, a couple of problems with it. One thing, if you're just looking here, maybe it's leg 1, pull back, leg 2, and overall the market is in a trading range. So it's a second leg trap. It also could be, it is close to the 50% pullback of the rally. And the odds were this was strong enough for buyers below and a second leg up. And this may be where the buyers came in, and this may be the start of the second leg up. And then a good bull bar, 62, probably going higher. But again, it's a trading range with lots of overlap, and I'm expecting there to be disappointment, especially after trend bars. Most trend bars have bad follow-through in trading ranges. So bad follow-through 63, but bad low 1, probably buyers below, and the rally from the low of 61 to the high of 62, certainly strong enough for buyers below and a second leg up. And that's what we got here, buyers below, and we may start a second leg up. But a trend bar, so you expect bad follow-through, and we're getting lots of overlap. Overall through here, the market is very sideways. It looks like this may be the range. Maybe it's something like this. This is the top of the range. This is the bottom of the range. The market's still low in the range. Okay to be long. But if you are trading through here, which most traders should not be, if you are, you're a limit order trader and you're betting on breakouts. You're betting that breakouts will fail. So you're fading breakouts and you're entering with limit orders because stop orders always force you to enter in bad places. And it's hard to construct a trade with a positive trader's equation with a stop order entry when the market is this tight. However, I think we're in a trading range, and I think this still needs a second leg, and this is a pullback, and this is part of the second leg, but the second leg will be much weaker than the first leg, and it will channel up, sideways to up, and that's basically what we had with a surprise bar on 78, but breaking out to a new high at the above this trading range. But same problem I said over here. How much of bar 78 is actually breaking out and how much is overlapping the range? It's probably, again, something like 20% is actually breaking out, 80% is overlapping. So we still need follow through, and then you don't get it, 79. for stop order trades today. Reasonable to sell below bar 2, might be always in short. You could sell below 6, bear bar closing near its low, or maybe you sell the close 5, sell the close 6, tight bear channel. And then down here for stop orders, really not much, except for here I thought bar 15. You could buy above 15. And let me go back here. I could have explained this part better. Bar 7, I mentioned it was climactic, but I didn't really mention this part very well, 7 through 9. It's hard to see on this chart, or it might be hard to imagine, but if we look at a smaller time frame, and I'll pull it up in just a moment, bar 7 is racing down, and then all of a sudden the market races all the way back up here. If you think about from the high of bar 7 to the low of 7, and then from the low of 7 to the high of the pullback, this pulled back maybe 80%, 90%. And that's a deep pullback, and that's a trend line break. And so that's what's not so clear here, because you might see a trend line like this. You say there's no trend line break, but in here, there's a steep sell-off, it's climactic, and then we got a deep pullback, and that's a trend line break. And so this is a small version of a major trend reversal. Bear trend, trend line break, resumption of the bear trend, we're getting a retest of the trend's extreme, and then we get a reversal, and in this case a major trend reversal. So let's look at it up to 10:05 on the 1 minute chart. This is Eastern time. So 10:05. Here is bar 7. So here's the close of bar 7 on the 1 minute chart. Steep bear trend, and then look at the next 2 bars. So 1, 2, 3, 4, 5. That's the next 5-minute bar. 1, 2, 3, 4, 5. That's the next 5-minute bar. So here's bars 7, 8, and 9. It's more clear that we have a trend line break here. Steep bear trend, deep trend line break. The bulls got to close above the moving average. And with such a deep pullback, this is one of those delayed second leg breakouts. So this rally should get a second leg, but rather than buy up here, the bulls will look to buy, well, traders in general will look to buy lower, maybe a 50% pullback, maybe even a 100% pullback, and they buy below this rally, betting that the downside is limited. And you can see the market converted into a trading range. You can call it a bear trend or a bear channel. We're getting lower highs and lower lows, but that's exactly where we found buyers below bar 7. And you can see steep sell-off, trend line break. The retest is weak, lots of overlap, and then a possible lower low major trend reversal. So stop order buy above 15 was reasonable. Maybe you buy the close 16, buy the close 17, buy the close 18, always in long, buy above any bar, closing above its midpoint. And if you exit, you can enter again above any bar, closing above its midpoint. 29, more of a profit-taking bar. Always in bulls, they see 29, they probably just take profits and wait for more information. Second entry short below 32, but not ideal. We're still within the range of 29, probably buyers below 29. I thought you could buy above 33, buy above 37. You could sell below 40, but if you're selling in the middle of a tight trading range, and you're going for a swing. Good entry bar, but you need more follow through, and then you're disappointed 43. So bears probably give up here and look to sell higher. And I mentioned this needs a second leg, but this is getting into limit order trading territory. So stop orders through here, really not ideal. Maybe you buy here, second entry long above 65, tight stop below, buy above, going for a test of the top of the range. And that's about it for stop order trades. Where do we go tomorrow? The market's been in a tight trading range, like I've said. tight trading range within a bigger trading range, and we're at the top of the big trading range, and we're at the top of the smaller tight trading range. So we have an outside bar. Outside bars are typically trading range bars. It depends on the context and where they are occurring, but we know we're in a trading range here. So even though we have a bull reversal bar closing near its high, there actually may be more sellers above the high of this bar or above the high of September 19th, which is currently the all-time high. I think we have to test 5,800, but if we do, or when we do, I think we'll probably find some sellers there. It does not look like the market is rallying with much urgency at this point. And we can look at this chart, the extended hours, Globex, and compare the buying through here and here and here to the buying through here. First of all, you look back and the market is in a bull channel, getting lots of bull bars, deep pullback, but then a lot of bull bars. Here, much deeper pullback. That's major disappointment. That's enough to convert the market into a trading range. Sellers above. We rally, we get another deep pullback. We rally, and we're getting small bars at the top of the range. So this all looks much different than when the market was rallying through here and through here. Bull leg, but then a pullback, climactic bar, inside bar, pulling back. Maybe they get one more push up. But to me, it looks like the upside here might be limited. All right, thanks everybody for watching. I hope everyone has a good rest of their night.